The kind of property that I would want to hold, I can't hold as the CFO of a publicly traded company. The kind of stuff I can hold, sovereign debt, it isn't scarce, and it's a currency derivative. And so Bitcoin is this new thing. It is a digital scarcity that's liquid, that's fungible, that gets commodity treatment, that I can hold on a balance sheet as a treasury asset. And while the currency is not generating a yield and the bonds aren't trading up in asset value and they're generating taxable yield and with a negative real yield, Bitcoin will appreciate in price tax deferred.
Today we are joined by Michael Saylor, who shares his insights into the price action and market dynamics for Bitcoin and why he's bullish in 2023. Saylor's positive sentiment is firmly rooted in two key factors: the upcoming Bitcoin halving event set for April and the impending approval of a Bitcoin spot ETF by the US Securities and Exchange Commission. Currently, the SEC is actively reviewing multiple applications for this ETF, with BlackRock emerging as the main player. Thanks to BlackRock's significant influence, there's an increasingly strong belief that, in the not-too-distant future, we'll witness the approval of at least one Bitcoin spot ETF. This would mark an historic milestone for the Bitcoin community, a moment many have been eagerly awaiting for well over a decade. The green light for such an ETF would carry profound implications for the world of cryptocurrency and would serve as the gateway to substantial institutional investments, drawing interest from sovereign wealth funds, major corporations, and even governments. Saylor envisions that this development will pave the way for large corporations to incorporate cryptocurrencies into their balance sheets. Let's get right into the latest interview with Michael Saylor and why Bitcoin is poised to revolutionize 2023 and the imminent transformations we can anticipate in the crypto market.
The significance of fair value accounting coming to Bitcoin is it makes the asset non-toxic for an operating company to hold, or a company that uses GAAP accounting. It also makes it transparent, the performance of Bitcoin-backed companies to be transparent. And so that's a positive feedback loop, right? When Bitcoin companies are performing well, it'll be obvious to Wall Street and they'll want to finance more of them, right? So that's a secondary benefit. And the third is, because Bitcoin is a commodity, it's a financial commodity, it can be held on the balance sheet of an operating company where right now only treasury assets or sovereign debt type assets can be held on that balance sheet as a treasury strategy. So before Bitcoin, there really wasn't any good fungible commodity that I might hold on the balance sheet. My choice was securities or property, but I can't really hold property on my balance sheet if I'm a corporation because it's not liquid. I can't buy $247 million worth of property a week and then liquidate $121 million in an hour, right? It takes me 6 months to buy a building, and it takes me 3 months or a year to sell the building. So that doesn't really work so well as a treasury asset. And then packages of securities are fungible and they're liquid, but securities are discriminated against by the regulators. And if an operating company holds more than 40% of its liquid assets in securities, it's deemed as an SEC 40 reporting company or a financial company. And once it gets deemed or designated as an SEC 40 company, the operating executives lose the rights to do many things that operating companies need to do, like issue debt, take on leverage, issue options, sell volatility, etc. The treasury strategy of an operating company is we want something which is liquid and fungible and low risk. So traditionally, the most liquid, fungible, low risk financial asset is just the dollar, the local currency, maybe the euro, maybe the dollar. And so that's the obvious thing to do. I collected $100 million this month, I put it in the bank. Now, the problem with that is that the dollar doesn't generate a yield. And the dollar is a depreciating, debasing financial asset. So in a world where the dollar gets inflated 7% a year, if the money supply of US currency increases 7% a year, and it has over the past 100 years, then $1 billion in cash is going to cost you $70 million a year in purchasing power. And of course, at 7% a year, over the course of 10 years, you'll cut your asset value in half. So it doesn't take a rocket scientist to figure out that a treasury strategy based just on currency isn't awesome. It's dilutive. The question here is, what's the next best thing? Well, the next best thing is sovereign debt. Sovereign debt is debt issued by a government. So you've got the most creditworthy counterparty, maybe the United States government. You don't really think they're going to default. And that's the advantage of sovereign debt. You might take on duration risk. If you buy long-term bonds when the interest rates are low and interest rates go up, then the bond will trade down and you could get wiped out that way.
The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Saylor asserts this journey is just beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Saylor highlights this being a significant development in the financial ecosystem. He also suggests that BlackRock, under the guidance of Larry Fink, will lead the charge in obtaining regulatory approval for a Bitcoin ETF. This move, he contends, will underscore Bitcoin's enduring relevance as an asset and its potential as a hedge against currency devaluation.
So the existing rules, they force everyone to make irrational decisions, take on debt they shouldn't take on, buy companies they shouldn't buy, issue dividends they shouldn't issue, and buy back shares they shouldn't buy back. And the significance of Bitcoin is in two ways. First of all, CFOs and CEOs starting in 2024 will now have the option to buy Bitcoin instead of buying treasury bonds. So now you can buy a commodity that's liquid and fungible on your balance sheet. And that commodity is a scarcity. And because it's a scarcity, that means you can expect it to accrete in value more than 7%, probably 14% a year over the long term, even after, I think after we've gotten through the bull run and after the early adoption boost, which will cause Bitcoin to appreciate at rates faster than 14%. In the long term, over the course of 100 years, starting a decade or 2 decades from now, you could expect it to appreciate at 14% a year if the money supply or the currency supply is appreciating at 7% a year or expanding at 7% a year. So you've got an asset which will appreciate in price versus fiat. And of course, bonds don't, right? Bonds never appreciate in price for the most part against fiat. You're buying them at par in order to get the taxable yield. So that's a big deal, right? It's not comparable to buying a portfolio of soybeans or silver or gold or oil or natural gas, because those are true commodities. And the problem with commodities, and Bitcoin doesn't have this problem. This is why people have to, we should really call it a scarcity rather than a commodity. The problem with commodities is there's a dysfunctional, systemic, endemic inflation built into the system. There's never been a commodity like Bitcoin that was scarce. The closest thing to something like Bitcoin would be acreage in Palm Beach or acreage in Miami Beach. Not the square footage, but rather the underlying dirt. Because there's only so many linear feet of beachfront property in Palm Beach for the last 100 years. And no amount of money printing, and no amount of capital, and no amount of technology, and no amount of manufacturing know-how creates more beachfront property in Palm Beach. So when you look at that scarce desirable property that you can't create more of, you can see that actually does go up in value. That's gone up by a factor of 1,000 in the last 100 years, 1,000x. And that appreciates at the rate that the money expands. But the problem is, it's not a treasury asset. I can't buy and sell square feet of Palm Beach every day in the market. I can't liquidate it on demand. So the kind of property that I would want to hold, I can't hold as the CFO of a publicly traded company. The kind of stuff I can hold, sovereign debt, it isn't scarce, and it's a currency derivative. And so Bitcoin is this new thing. It is a digital scarcity that's liquid, that's fungible, that gets commodity treatment, that I can hold on a balance sheet as a treasury asset. And while the currency is not generating a yield and the bonds aren't trading up in asset value and they're generating taxable yield and with a negative real yield, Bitcoin will appreciate in price tax deferred.
Saylor challenges the conventional macroeconomic metrics, asserting that these metrics are often manipulated to paint a specific narrative, like labor statistics and inflation figures, which are selectively measured to create desired effects rather than reflecting the true state of the economy. In this context, Bitcoin emerges as an alternative, detached from the manipulations of the conventional economic sphere. Saylor also highlights that established corporations like Apple, Amazon, and Google will use their established relationships acquired over decades to swiftly acquire substantial amounts of Bitcoin through a spot ETF, bypassing the cumbersome processes involved in procuring the actual commodity. This disparity underscores the transformative power of cryptocurrencies in traditional financial institutions. Michael Saylor underscores the importance of embracing digital currencies as the economic landscape is changing rapidly, and urges investors to leverage Bitcoin's potential to secure a more prosperous financial future. What do you think about the latest interview with Michael Saylor? And how do you think Bitcoin's trajectory in the coming months will impact the crypto market and the world of investing? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.